Good day. Welcome to another session of Bug Accountancy Tutorials. Today we are going to look at adjustments for final accounts with a specific emphasis on final accounts of a sole trader. We want to look at adjustments for the final account, end of year adjustments. Now we know that final accounts are prepared from the trial balance. And so we balance off the account, we extract the trial balance, and then from the trial balance we prepare the final account for a sole trader, that is the income statement and the statement of financial position. Now we are going to look at adjustments. You will normally realize that when you get a question, after the trial balance, we see additional information or footnotes or what the others may call further information. You see other adjustments down there that you're supposed to make on the account. Now what I want you to understand is that these adjustments, if not done, will not make the account very valid. Now, there is a rule that I want us to go by, that whenever you see a question of a final account where there is a trial balance and an additional information for adjustment, the items in the trial balance should be treated once, but the items in the additional information should be treated twice, mostly. The reason being that what is in the trial balance has already gone through the double entry system. And so we have already done the double entry of it, and then we have extracted the trial balance. The things in the additional information usually have not gone through the double entry system. They only occurred, or we were only made known of them after we have extracted the trial balance, and that is why we didn't take note of them. And so what we do is that in preparing the final account, we treat them twice to complete their own double entry. And that is why we treat items in the additional information twice. It must be treated twice so that it will go through the double entry system. And so we are looking at adjustments for final account. Of the sole trader. Okay, so what I want us to do basically is that we are going to look at the most common adjustments that you can see first, and then learn how to treat them. And then from there, we'll talk about other adjustments that may come that you may not have seen before. And so, remember that I told you that we are going to treat the items twice as they appear in the additional information. And so I'm going to start listing some of the common adjustments that you can see and explain how we are going to treat them. And the first part that is likely, or you always see in the adjustments, are the issues of accruals and prepayments. That is prepaid expenditure or prepaid expenses, and then prepaid income, and then expenses owing, and then expenses or income owing. Yeah. Okay, so we are going to look at accruals and prepayments for both income and expenses, which is likely to be part of the additional information. And I want us to begin with expenses. Expenses. Expenses can be prepaid or can be owed or outstanding. Now, when we say expenses are prepaid, the meaning is that we have paid in advance. So we are looking at expenses prepaid, or another name for prepaid is paid in advance. So when we are supposed to pay an item of expense for the year, and we pay more than we are supposed to pay, with the mentality that that will offset what we are going to enjoy next year, and then we have overpaid. For example, you rent a house, and the rent we are supposed to pay 600 per annum, 600 cedis for the year, and you know that you can stay in the house for more than 1 year, and so you decide to pay 800 cedis, so that next year instead of paying 600, you just subtract the 200 that you have overpaid and pay 400. That may be your mentality. But when we are preparing account for this year, we know that the rent expense is 600 and not 800. And so what we are going to do is that we are going to only record the 600 as an expense. And that is what we do. We don't care about what you have paid. Now, the accrual concept tells us that at the end of the year, expenses for the period should be matched against revenue earned for the period. Expenses incurred for the period should be matched against revenues earned for the period. And so our focus is on expenses incurred and not expenses paid. We want the expenses incurred, not expenses paid. Incur means that is what you are supposed to pay for the year. That is what you are supposed to pay. Paid is what you have actually paid. And so if your rent is 600 cedis and you pay 800 cedis, the difference is this, that you have incurred expenses of 600 cedis, but you have paid 800 cedis. And then what we have on the trial balance is always what we have paid. When you have a question, the expenses that are on the trial balance are what you have paid, not what you have incurred. When you pay, you go through the double entry. For example, you pay rent of 800. You are going to debit rent of 800 and credit cash of 800. And so when you do the double entry, your balance brought down for rent will be 800, and you put that 800 on your trial balance. And so it is in the footnotes that your attention will be drawn to the fact that that 800 up there is what has been paid. And so there is an extra $200 that has been overpaid that we call expenses prepaid or rent prepaid. And so if you want to see the actual rent that should be treated as expense for the year, then you should take out that 200 which has been overpaid so that you will get the actual 600. That is the essence of this. So what we need is that in the final account, we take into consideration expenses that are incurred and not the expenses that have been paid. When it comes to income, we take into consideration income that has been earned, not income that has been received. What you have earned. So there is a difference between earned and received. Now, received is what you usually see on the trial balance, but earned is what you need on the financial statement. And so if you are expecting an investment income and you know that this year you're supposed to take 1,000 cedis for your investment income, and the company pays you 1,005 and you take it, on your trial balance 1,005 will be there for investment income because that is what you have actually received. But in the additional information, they will tell you that 500 of that amount has been overpaid to you. And so what do you need? You need what you have earned. You have not earned the extra 500. The extra 500 you have not earned is called unearned revenue. And so you have to take that out from the 1,005. Then you put only the 1,000 that you have earned on your financial statement. And so that is basically what we are talking about. That when it comes to accruals and prepayment, we need what we have, expenses that we have incurred and the revenue that we have earned, not what we have received or you have paid. So take note that we want to talk about what we have incurred or what we have earned. And so coming back to my expenses prepaid, I will say that whenever I see an expense prepaid, from the explanation that I have given so far, expense prepaid means that we have overpaid the expense. And if we, the company rather, because we are looking at ourselves as a company, we the accounts people. So if we have overpaid the amount, for example, if the rent was supposed to be 600 and we have paid 800, the extra 200 has been overpaid. And so when we are preparing the final account and we see down there that rent has been prepaid by 200, then that 200 must be subtracted from what we have been paid or we have paid. And then the difference is what we are going to take. And so when we get to the expenses portion of the final account, expenses portion of the income statement, we are going to write, let's assume that we had rent of 800 on the trial balance. Let's assume that we have rent of 800 and we are told that we have prepaid rent by 200. Then it means that if this is a trial balance and we have rent of 800 and we are prepaid by 200, on the face of the financial statement, our rent that has been paid is 800. We do that, we have three currency signs. Okay, then I told you that the second currency sign is for expenses. But what we are going to do is that we are going to write the 800 and then subtract with less the prepaid rent of 200, so that the final figure of 600 is what is going to be recognized as an expense. So what I mean is that whether you have overpaid or underpaid, we are going to look at underpayment. This is for overpayment. But whether it's overpayment or underpayment, you need the expenses that you have incurred. Take note of that, and not what you have earned. We need the expense that we have incurred, not what we have paid. And so we have paid 800, but we are told that 200 is overpayment. So we just show what we are supposed to pay, and that is what we call incur. Now let's take note. I told you that Anytime there is an adjustment in the additional information, it should be treated twice. And so for the expense prepaid, we have said that the first treatment is that this is what we are going to do. We are going to less it from the paid rent to get our incurred rent. Now, looking at this, there is rent of 800 in the trial balance, like I said. Then there is a prepaid rent in the additional information. Which one are we supposed to treat twice? Is it this or that? Obviously, it's this. It's the 200 that is supposed to be treated twice, because that is what is in the additional information or the footnote. And so the first treatment of this 200 is what we have just done by subtracting it from the 800. The second treatment is that because we have overpaid, take note, because we have overpaid that 200 is an asset to we, as the company. It's an asset because we have not used the facility, but we have paid. So if at the end of this year we decide not to stay in that house again, the landlord obviously has to pay back our rent. And so that money that we have paid in advance becomes an asset to us. But it is a current asset because it is not going beyond one accounting period. And so the second treatment of this prepaid rent is that it's going to be treated as a current asset in the statement of financial position. So the first treatment for expenses, whether it is rent, insurance, advertising, any expenses that is prepaid, the first treatment, one, is that we are going to subtract it from the paid figure and get our actual figure incurred. And the second treatment is that we are going to take the expense prepaid as an asset, as a current asset in the statement of financial position. I believe the understanding is okay. Alright, so that is it with the expense prepaid. And so I want to highlight that expense prepaid is a current asset. So you first have to subtract from the income statement and then you treat it as a current asset. So now that we are done with expense prepaid, let us look at expenses owing. So expenses owing. That is the opposite of expenses prepaid. Now, how do we treat expenses owing as well? Now, I told you that another name for the prepayment is paid in advance. When we come to owing, for the expense owing, you can see them in different names. They can give you 5 different names, which is the same as expense owing. You can see the expense as owing, or the item of expense you see it as in arrears. So when you see arrears, it's owing. Or you can see it as outstanding. Or you can see it as accrued. Or you can see it as expense due, D-U-E, due. So whichever way that you see it, it is the same thing we are talking about, whether it is owing, accrued, in arrears, outstanding, or due. We are talking about expense owing. And expense owing simply means that we did not pay up to what we have incurred. Taking the same 600 cedis rent, for example, if I'm supposed to pay 600 cedis rent to my landlord as a business, and I pay just 500 cedis for the year. Now, I told you that in the trial balance, it is only what has been paid that will be in the trial balance, not what has been incurred. And the accrual concept and the matching concept tells us that we need to match what has been incurred, not what has been paid. And so, if I pay 500 on my trial balance, I will see 500. So it is prudent that the additional information will draw my attention to the fact that expense of 100 cedis is owing, or rent of 100 cedis is owing for the year, or insurance of 100, or whichever expense that is it. They will have to let me know that it is owing. And so if I pay 500 and I'm owing 100, then how should I treat the 100? Remember that I told you that we need what has been incurred. And so when we go to the financial statement, the expenses portion of the income statement, we are not supposed to record only the 500. But this time around, we are going to add 100 cedis to it to make it 600 cedis, so that we will have a total expense. So we are going to say that when we get to expenses, we will say that if it is rent, we will first write the 500. Then we add the rent owing of 100. Then we are going to get a total rent of 600. And so whether it was a prepayment or an owing, the value that should go into the financial statement was still 600. And that is what I'm trying to say, that if you overpay, you take it off. If you underpay, you top it up. And that is basically the dynamic of adjustments for final accounts as far as this is concerned. And so when there is owing, you add owing. And if it is a prepayment, you less prepayment. Of course, this is the first part of the treatment. I told you also that it should always be treated twice, whether it is prepayment or owing. And so additional information items should be treated twice. And so the first treatment for this 100 cedis is that we have added it to what has been paid and we have gotten a 600. The second treatment of that 100 cedis alone is that because we are owing, it is a liability. And so when we get to the statement of financial position, the 100 that we have not paid obviously will go as a current liability. And so when we get there, we will say that expense owing will be a current liability. And so that is basically what we are saying, that expenses prepaid are current assets and expenses owings are current liability. Because we have not paid, we have used the facility we are supposed to pay, so it becomes a liability. And that is basically what we are talking about. But when we get to the income statement, let us know how to treat each of them. So let me repeat again by saying that expenses prepaid will first be added and will first be subtracted, expenses prepaid will first be subtracted from the expense that has been paid, and it will be treated secondly as a current asset. Now expenses owings will be added to the expenses that have been paid, and then to be treated as a current liability. These are the double treatments for both expenses prepaid and owing. Okay, and I think you are okay with that. Then let us also look at the income aspect of it, other income. So let's look at income prepaid. Income prepaid. This time it's an income prepaid. For example, you have an investment income and they have paid it for you in advance. This time around, it is not an expense. We are rather receiving. And just like an expense, I told you that we need what has been incurred, not what has been paid. When it gets to the income, we also take into consideration what has been earned and not what has been received. You can receive an income that you have not earned. It's not for you, it just came into your account. And so we also are interested, the final account is interested in the income that you have actually earned for the year. And so if I'm supposed to receive 1,000 as my investment income and the investment agency pays me 1,500, what has been paid to me, what I have received is what will be in the trial balance, like I tell you. So up there in the trial balance, I will see 1,005 for investment income. So you will see, let's say something like this, investment income, and you see 1,500 on the trial balance. Then when you come to the additional information, you are told that investment income is prepaid by 500. Now the meaning of this is that if it is prepaid by 500, it means that they have overpaid us, because this one is rather income, we have not paid. So they have overpaid us by 500. And obviously, what do you think should be in the statement of profit or loss or income statement? It should be the 1,000 that we are supposed to receive. And how are we going to treat it? When we get to other income in the profit and loss account, we are going to write investment income. Now we are supposed to write 1,005 and less the prepayment of 500, so that we can have a final figure of 1,000. And that is basically what we are going to do. We are going to say investment income of 1,005 less the prepayment of 500, and we have the 1,000 that has been earned. And so I come back to tell you that whether it is income or expense, prepayment must always be subtracted in the income statement. The same is true for owings. Owings must always be added, because you need to top it up to know what you have actually incurred or earned. And so income that is prepaid will also be subtracted from the income statement. Now when we get to the second treatment, I told you it should have two treatments. So the first treatment for this 500 is that we have subtracted it from the investment income in the income statement. But when we get to the statement of financial position, this investment income, because we have not earned it, but it has been paid into our account, we have gotten it. It is an unearned revenue, and unearned revenues are liabilities. So this income prepaid will go as a current liability in the statement of financial position. That will be the second treatment. So let us take notes. We have to really sharpen our understanding of these adjustments because we need them. It is a foundation. Before we can even build on to other financial reporting topics, we need to understand these things very well. Other than that, our accounting will always be in the mark. Okay, so income prepaid will become a current liability. But first, it will have to be subtracted from the total figure that has been received. All right. And so that is it for the income prepaid. And then finally, on the accruals and prepayment, let us look at the income owing as well. Income that is outstanding. Now, we are supposed to receive 1,000. That is what we have earned for the year from our investment. But then we are paid only 750 into our account. And so we know that we have earned 1,000, but they are paid us 750. And that 750 is what is going to be on the trial balance. The extra 250 that has not been paid obviously will be disclosed in the additional information as investment income owing. And this time it's an owing to us. We are not owing. They are owing us. And so just like the owing that we treated with the expenses, it should be added to the 750 to get the 1,000 because we need what we have earned, not what we have received. And so when we go to the income statement, it will be investment income of 750 plus the investment income owing of 250, and then we get the 1,000. We need the 1,000 at all costs, whether we are being underpaid or overpaid. And so what we are saying is that owings will always be added, and then prepayment will always be subtracted, whether it's an income or expenses, as far as the income statement is concerned. But the treatment, the second treatment in the statement of financial position is what differs. When we get to the statement of financial position, that 250 that has not been paid to us, because it is our money that has not been paid to us, it's like a receivable to us, so it is a current asset. So income owing will end up as a current asset in the statement of financial position. And so if you look at the dynamics of what I have just listed, you will see that whilst expense prepaid is a current asset, income prepaid is a current liability. And whilst expense owing is a current liability, income owing is a current asset. So that is how the dynamics are. I'm sure that you will take your time and go through and understand it well. And I know that from after this lesson, your knowledge of this adjustment should really go up. Okay, so that is it with the prepayment and accruals. So the next expense, the next adjustment that I want us to look at, very, very important, is the provision for doubtful debts, or what we call allowance for receivables. All right, and so that is very important. Now what we do is that, now there's a difference between bad debts or irrecoverable debts and allowances for doubtful debts or allowances for irrecoverable debts. Now what we are going to do is that we are going to learn how to treat them. Now you will see that you are going to have, okay, let me say, so I'm talking about allowances for irrecoverable debts. Or what we used to call provision for doubtful debts. So, allowance for recoverable debts or provision for doubtful debts. Now, this is very dicey. What we do is that this provision for doubtful debt is always calculated on the receivables or the debtors figure. And so, whenever you have receivables, trade receivables, or what we used to call debtors, trade receivables, we make an allowance, a percentage allowance on it as a general provision, so that when in case they don't pay their debt, then we don't suffer. We just apply the prudence concept, which states that we should always anticipate losses in the future and not anticipation of profits. So we always anticipate that some of the debtors may not pay. And so we calculate a percentage on the debtors or the receivables figure, and then we say that this percentage is likely they will not pay. and so let us treat that as an expense, and that's what we do. Now, when it comes to these provisions, we are going to look at it as a full topic on its own later. But we know that there is bad debt, specific ones, that these ones they will not pay. Those ones must already be taken out of the trade receivables figure. That one we are sure that they will not pay. And then there can also be a general provision where we don't know who will not pay, but we are just making the provision or an allowance that it's likely some may not pay. Now, what we are going to do is that bad debts, when they are on the trial balance, has already been subtracted from the debtors. So you don't need to subtract them again before you calculate your provision allowance. But when bad debts are in the additional information, it tells us that they have not already gone through the double entry system. And the double entry system for bad debts or irrecoverable debt is that we debit the irrecoverable debts account and then we credit trade receivables or debtors. And so when they are in the additional information, we must first of all subtract from the debtors figure or the receivables figure before we get a net receivables figure. But when they are already in the trial balance, it means that this irrecoverable debt has already gone through the double entry system and we don't need to subtract them again. And when we come to the provision for doubtful debt or the allowance for recoverable debt, after the debt has been adjusted, the bad debt has been adjusted already and it's not in the additional information, then what we are going to do is that we are going to calculate a provision. Now take note that provision, some organizations make allowance for receivables every year, and so it's likely that in the trial balance there is already a provision adjustment from last year that is in the trial balance. Sometimes you also need to not see a provision adjustment in the trial balance, and whichever way that is going to be, the treatments are not going to be the same. And so let me give an example that you have a trial balance where you have trade receivables or debtors figure of 1,000, and then in the additional information one says that bad debt is 100 cedis, and then provision for the bad debt is 10% on debtors. Now take note that if this bad debt of 100 cedis is in the additional information, then it means that it has not yet been adjusted on that. So before we calculate this 10% on this figure, we have to first of all take out the 100 cedis of bad debt to get the 900 before we apply 10% on on the 900, simply because this 100 has not gone through the double entry system, and so we need to subtract the 100 from the 1,000, get the 900 before we calculate the 10% of on the 900. And so it will be 10% of 900 will give us 90. Now if we are solving and we see the otherwise, that bad debts or irrecoverable debts are already on the trial balance, then the meaning is that it has already been adjusted before we got this 1,000. So we are not going to subtract from the 1,000 again. And so when we want to calculate this 10%, the 10% will be calculated straight away on the 1,000, so that we are going to get our 100 cedis for allowance or provision for doubtful debt. That is the dynamics of the provision. All right. So this is how the calculation is supposed to be done. Now, getting to the treatment. With the treatment of provision, it is very dicey. Okay. There are three different ways that we are going to see the provision for doubtful debt or allowance for receivables. We are going to see it in three different ways. Now, one of them is that, okay, so let me try and get you a table to understand what I really mean. We are going to look at the provision for doubtful debt. I'm trying to use a table to explain how provision for doubtful debt is to be treated, or allowance for receivables is to be treated when it comes to the financial statement. Now, let me call this place type, and then I'll call this place TB, which is trial balance, and then I'll call this place AI, which is additional information, and I'll call this place treatment. So this is a table that I have devised to try and explain how provision for doubtful debts are being treated. Now, we can have three different types of provision for doubtful debts. It will come in three different types. Now, type 1 is that you are going to see provision for doubtful debts in the trial balance, but you are not going to see it in the additional information. That is why I've used an X. You are going to see it in the trial balance, but you don't see it in the additional information. Now, how are we going to treat that? So, for example, you have a trial balance, and in the trial balance, you have provision for doubtful debt 200. But in the additional information, nothing was said about provision. How are you going to treat this? I know many people will just pick this and take it as expense. But whenever it happens this way, the treatment is that you don't treat it at all. It is not going anywhere into the financial statement. As a matter of fact, sometimes I even say if it's an exam, it is just there to confuse you. Don't take it at all, because this is last year's provision. Take note that whatever provision for doubtful debt that is in the trial balance is last year's provision, and the one that is in the additional information is this year's provision. Now, we are preparing account for this year, not last year, and so we need this year's provision to be taken as an expense, not last year's provision. Now, the purpose of last year's provision is just for comparison with this year's provision. And so if this is from last year and this year we didn't create any provision, then of course we are not going to take any provision for doubtful debt into the financial statement. So that is what we are going to do. I said that it has two treatments. The first treatment is that I would say leave it alone. Don't treat it. So that is, I would say that is the treatment. Don't treat it at all. Don't treat it. We didn't create any provision this year, so we are free. We are okay. Then when we get to the type 2, for type 2, we will say that there is no provision here, but there is no provision in the trial balance, but there is provision in the additional information. Now, what we are going to do is that when there is no provision in the trial balance, but there is provision in the additional information, then of course, it means that this time around, we have created provision for this year. This is for last year, and this is for this year. And if we have created provision for last year, you have a trial balance where you don't have provision. But in the additional information, there is provision for doubtful debt. Then what we are going to do is that this figure, if the provision, for example, is 100 cedis for this year, after calculating we have 100 cedis, and then last year there was no provision. Then what we are going to do is that this one will be treated twice because it's in the additional information. And so the first treatment is that take the full figure as expense in the income statement. So the first one is that this one will be taken as an expense and to the income statement. It will be treated as an expense. Then the second treatment for this 100 is that now this 100 was calculated on the debtors or the receivables figure. So what we are going to do is that because it was calculated on the receivables, when we get to the statement of financial position, we are going to subtract this 100 from the figure of the receivables in the income statement of financial position. So we reduce receivables. So the second treatment is that take the full figure and subtract it from trade receivables figure in the statement of financial position. Alright, so we take the full figure and then we subtract it from the statement of financial position, and that is basically what we are going to do. So that is for type 2. So type 2, where there is no provision in the trial balance but there is provision in additional information. First treatment is that you take the full figure as an expense, and the second treatment is that you take the full figure and you subtract it from the receivables figure in there. So when you go to current assets, you see trade receivables, you subtract the provision figure, and then you get the net receivables. That is the second type, and that is the treatment. Now the final type, type 3. Type 3 is when you have the provision in the trial balance, and at the same time you have it in additional information. And this is another area where a lot of people find difficult to understand. Now, when you have provision in a trial balance, and at the same time you have some in the additional information, I have already told you that what is in the trial balance is last year's provision. This is this year's provision. And I told you that it is given for just for comparison. So let's assume that this is our trial balance. We have provision for doubtful debt of 100 from last year. And in the additional information, we are told that provision, maybe they say it's 10% on debtors, but after calculating, you have 150 cedis as your provision. Now what we have done is that this is last year's provision, this is this year's provision, and that is exactly the type 3 I'm talking about, where you have provision in the trial balance and you have some in the additional information. Now how are we going to treat it? Are we going to pick this as expense or this as an expense? What we are going to do is that we are going to compare and take the difference. So if you compare this year's provision of 150 to last year's provision of 100, the difference is 50. It is the difference of 50 that we are going to take as an expense. So it's not going to be either this or that. No, we are going to just compare and take the difference. Now, in this case, it has increased by 50. So we are going to take it as an expense. Let us assume that if after calculating this year's provision we had 80 for this year and last year is 100, what has happened is that when we compare, it has decreased and the difference is 20. And so this time around, the difference of 20 will not be an expense, but it will be taken as other income. So when it comes to the type 3, which we normally see in the questions, the difference is what matters as far as the income statement is concerned. We are going to take an increase in provision as an expense, and a decrease in provision will be taken as other income. And so let us take note that when it is increasing, it is an expense. When it is decreasing, it is an income. Now the second treatment for the provision of the type 3 is that when we get to the statement of financial position, the second treatment is just like that of the type 2. We are going to take the full figure and we are going to subtract from the trade receivables in under current assets. We will subtract the this year's provision. And so when we get there, it is this 80 that we are going to subtract. Now in the case where it was 150, okay, let's assume that it's 150 and the difference of 50 is taken as an expense. When we get to the balance sheet or statement of financial position, we are going to subtract this whole 150 and not the difference. And so the statement of financial position does not cater for only differences. It takes the full figure to the statement of financial position to subtract. But when it comes to the income statement, we only need the difference. So the type 3 is very cumbersome, but I'm happy that you are getting it now. And so what we are going to say in our treatment is that with the type 3, the first treatment is that I will say compare and take the difference. Then I will say an increase is an expense, and then a decrease is income. So that is the first treatment for the type 3. We compare and take the difference, and then the increase is an expense and the decrease is income. And then the type 2, the second treatment is that we take the full figure for this year and subtract from trade receivables in the statement of financial position. So that is the last type, or the type 3. And so this table basically is what you need to read and understand very well. That when it comes to the provision for that, for that, or allowance for receivables, study the table very well and then let it guide you in every question that you want to solve from henceforth. And I believe that you'll be fine with this table. All right. That is it with the provision. The next adjustment is depreciation. And so we'll look at how to treat, that is adjustment number 6 that I'm looking at. Depreciation of non-current assets. Depreciation of non-current assets. Now, with the depreciation, we have the methods that we use to calculate. Each organization may either go by a method of their choice. You can either go by the straight line method or the reducing balance method or other methods that are available. Now, when you get a question under final account of a sole trader, depreciation is usually in the additional information, and it is also supposed to be treated twice. What we do is that we calculate the depreciation based on the method that they have told. So if it is a straight line method, the straight line method is depreciation on cost, and the reducing balance method is the depreciation on the net book value or the carrying amount. And so if you have a trial balance like this, and let's say you have a motor van with a cost of 1,000 here, and then you have, sometimes you see provision for depreciation. Now this provision for depreciation is the same as the accumulated depreciation. It will be on the credit side of, let's say, 600. Now for the motor van, what it means is that this, we bought the motor van for 1,000, and then it has been depreciated over the years up to a value of 600. And in the additional information, we say that depreciation is 10% on cost. Now, if the question says it should be calculated as 10% on cost, it is the same as 10% on straight line method. Straight line method, then it means that we are going to apply this 10% rate on the 1,000 to get the depreciation. Now, if it says 10% reducing balance method, reducing balance, the reducing balance means that we have to subtract the accumulated depreciation from the 1,000, and then we are going to get a difference of 400. And this 400 is what we are going to calculate the depreciation on. And so it's going to be 10% on 400, which is the difference between the two. This is how we calculate for the reducing balance method. And so let us take note that if it is a straight line method, we calculate on cost, and if the reducing balance, we calculate on the. Now, take note that another way this could have been presented is that they will not bring the 1,000 and the 600, or they will just say that motor van, then into brackets they will say cost 1,000, then they will put 400 here. Take note very well. They will just say motor van into bracket cost of 1,000, then they will put 400 here, so there is no accumulated depreciation. Now let us understand that the equation is that cost minus accumulated depreciation will always be equal to net book value. And so if you are given cost and accumulated depreciation, you should be able to find the net book value. But if you are given the cost and the net book value, you should also be able to find accumulated depreciation. So what you are going to do is that when this happens, this is your cost, but this is already the net book value that has been given. The depreciation rather was not given. And so when you are asked to calculate on cost, you calculate on the 1,000. If you are asked to calculate on the reducing balance method, you calculate straight away on the 400 because it has already been netted for you. Because accumulated depreciation will be on the credit side, but if it is on the debit side like this, then it is the net book value. So let us know the difference. Coming back to how we are going to calculate, treat the depreciation after it has been calculated. After you have calculated your depreciation on the non-current assets, what we are going to do is that it also has two treatments. The first treatment is that it will be treated as an expense. So when we get to income statement expenses, we put depreciation as an expense. And then the second treatment is that when we get to the statement of financial position, it will reduce the value of the asset. So when we get to non-current assets, we will put the cost. So normally when we get to non-current assets, you see cost accumulated depreciation, and then the net book value. So what we are going to do is that taking the example I give, for example, the cost was 1,000. The accumulated depreciation in the question was 600. Now let's assume that this year's depreciation we had 40. So if we calculated depreciation on reducing balance method, and it's 10% on 400, and we are getting 40, then it means that this 40 will be taken first as an expense. But when we get to the statement of financial position, the second treatment is that we are going to take this 40 to accumulated depreciation. But this is where most of us default, that there is already an accumulated depreciation of 600. That one is already here. So if you are taking 40 as accumulated depreciation, then you are going to add to already existing accumulated depreciation. So this place is going to be 640, which is going to reduce the asset value to 360. And so that is basically how we are going to look at it. So depreciation will be treated twice. First one as an expense, and second one to go and reduce the asset value in the statement of financial position. The last but not the least that I want to talk about for now is drawings. Now I told you that we have two types of drawings. We have stock drawings and then we have cash drawings. Drawings, when it goes through the double entry system, will be on the trial balance. And when it's on the trial balance, it will be on the debit side. It means that it has already gone through the double entry system. So it will be treated just once. We are going to reduce it from our capital in the statement of financial position. But when you see drawings in the additional information, it means that it has not gone through the double entry system. It will be treated twice. Now, whether cash or stock drawing, the treatment will be different. When the stock drawings are in the additional information, this is how it's going to be. You are going to see that the proprietor has taken goods for personal use, and the double entry is this. Now, from after all that I have done, it comes back to the double entry. When the proprietor takes goods for personal use, okay, it is your stock that is reducing. Your stock reduces, and then drawing increases. And so it is debit drawings, credit stock. But in this case, we are going to take it out from the purchases, because purchases is the representation of the stock account. And so when it happens that we are going to, the owner has taken for personal use, we are going to reduce. The first treatment is that it's going to be taken from purchases. And so when we are doing the trading account and we get to purchases, we add carriage inwards, we take out return outwards, and then we also subtract stock drawings. Now the second treatment is that because it is drawings, it will be taken to the statement of financial position and subtracted from the capital. If you have already drawings in the trial balance, you add it to that drawings before you go and subtract. Now when it is cash drawings, what is the double entry for cash drawings? When the proprietor takes the cash for personal use, it is debit drawings and credit cash. And by crediting cash, it means you are subtracting from the cash. And so for this cash drawings also, the two treatments are that the first one, you are going to subtract it from your cash figure in the statement of financial position. So when we get to the statement of financial position, and then you write your cash, you subtract that drawings figure from it. And then when you get to the finance by, under the same statement of financial position, you subtract the drawings from your capital. So for cash drawings, all the two treatments will be in the statement of financial position. By you are going to, by taking out it from the cash, and then you also less it from the capital. That is how drawings is going to be treated. Now take note that apart from this 7 that I have given you, there may be a lot of adjustments that you can meet, which may not be in what I have done, but it is your knowledge of the double entry that will help you. Like the drawings, you just always need to ask yourself, what is the double entry for this, and then you apply them. So definitely the double entry, the items of the double entry or the account headings of the double entry that you are going to apply are already positioned somewhere in the financial statement. So if your double entry is, for example, cash and rent, they tell you that they paid cash, they paid rent of this by cash, but it wasn't recorded, for example, and you are supposed to do this in your final account. The double entry is debit rent, credit cash, and so you debit rent means that you are increasing the rent figure, and so your expenses of rent will go up, and then your cash will decrease by the same amount. So basically, adjustments go with the double entry. You need the knowledge of a double entry principle to be able to understand and apply these adjustments. All right, so that is basically some few adjustments. We'll look at more when we are solving questions. Now in our next video, we are going to take a question where we are going to solve a full question on final accounts with adjustments, and then we are going to solve, and then we will understand how this thing really applies. Thank you so much, and subscribe to the YouTube channel for more videos. Thank you. Bye.